Well, welcome to this annual evidence session with the Chancellor here at the Economic Affairs Committee of the House of Lords, and we're delighted that we are joined today by Right Honourable Rachel Reeves, Chancellor of the Exchequer, and with her Beth Russell, Second Permanent Secretary at Her Majesty's Treasury, and Stephen Farrington, Director of Fiscal Policy at Her Majesty's Treasury. I should say that we are broadcasting this session live on Parliament Live TV, and a full transcript will be taken, which is going to be made available shortly after the meeting so that you can make any corrections. Let me start, Chancellor, by asking you a general question about the economic moment that we're in. It's a time of huge economic challenges: ageing population, stagnating growth, fragile public services, the need to adapt to climate change, tariffs from the US, and our fiscal position is also very challenging, with record borrowing, the highest tax take for many years. Given these multiple constraints, maybe you could outline what exactly your strategy is for achieving growth, the thing that you've consistently made your main priority. And I guess slightly more pointedly, how can you restore healthy levels of growth without either borrowing more than your fiscal rules allow or boosting current spending more than your tax commitments allow?
Well, thank you very much, Lord Wood, and it's a real honour to come and address you for the first time as Chancellor of the Exchequer, so thank you for giving me that opportunity today. As you say, we are living in an age of insecurity today, and economic policy has to respond to the moment which we live in. At the same time, we also have a challenging economic inheritance, with high levels of tax as a share of GDP, historic high levels of government debt, and then also economic growth that really for the last 15 years has been very poor by historical standards because of the weak productivity growth that we've experienced in that period of time. But just to sort of go to the first point that you raise about the sort of economic moment and that age of uncertainty and instability in which we're living in, the growth strategy has to be the right one for this era. In different areas, a different growth strategy would be appropriate, but we have to respond to the times we live in. And so that's why our growth strategy is about building resilience and stability. And we've sort of got these sort of three pillars that we think about in terms of our growth strategy. First of all, the pillar of stability, then the pillar of reform, and then the pillar of investment. So I'll just take you through those in turn, but I think also hopefully that will explain how they link to the fiscal rules that I brought in the budget last year. So the first pillar is around stability, and that means having fiscal rules that you stick to, because there's always fiscal rules, but they tend to change quite regularly. And so the sort of fiscal rules that we've introduced both embed stability, but also prioritise investment. So the stability rule is that we have to get day-to-day spending funded by tax receipts. That's something that hasn't happened for, well, at least a couple of decades. And the second rule is the investment rule, and I'll come on to that in a little bit, but getting debt down as a share of GDP, but subject to that being able to invest in things that improve our productivity performance. So separating out day-to-day and investment spending, because otherwise it's just too easy to squeeze investment spending, which is absolutely essential for delivering that long-term growth. So stability is the first pillar, and it's that stability which has enabled the Bank of England, the MPC, to cut interest rates 4 times in the last year. And despite the challenges, and we have faced challenges this first year, and the international geopolitical backdrop is probably not one that any government would want, but that is what we have. But despite that, in the budget, in the spring statement, and in the spending review, we showed that we were able to stick to those fiscal rules, that we had the political courage and strength to stick to those fiscal rules, and we will continue to do so. The second pillar of our growth strategy is around reform, and that reform is really wide-ranging. So reform to the planning system, and planning and infrastructure bill is before your House at the moment. And I would encourage Lords, when they're looking at that bill, to think about how quickly we can get it signed into law, because the quicker we can do that, the quicker we can actually get things building in Britain again. And one of the big challenges we've faced, and it's a similar challenge to other countries as well, is the difficulty in actually getting things done, whether it is building transport infrastructure, energy infrastructure, the homes that we need, the digital infrastructure, which is so important now with the growth of data centres and technology and AI. So being able to get things built. So the planning and infrastructure bill is absolutely crucial to that. We've got the pensions reform, which is unlocking long-term patient capital to help grow our economy. The regulatory reform, which you would have seen at Mansion House. You also would have seen from what the Environment Secretary and Sir John Cunliffe have done in terms of water and regulation of the environment. And trade policy is also an important area of reform, where in the first year of this Labour government, we've managed to be the first country to get a trade deal with the US. We have got a reset with our relationship with the European Union. We have agreed a trade deal with India, and we are progressing trade deals with Switzerland, the Republic of Korea, and also the GCC. So that's reform. And then the third part is investment. And investment is a mixture of both public and private. So the fiscal rules that I set out in the budget last year have unlocked an additional £120 billion of capital spending during the course of this Parliament, which is why in the spending review I was able to set out £750 billion of capital spending during the course of this Parliament. And then using financial transactions, particularly through the National Wealth Fund, the British Business Bank, we're also able to unlock further investment in line with those fiscal rules, which now count the assets, the financial assets on the government's balance sheet, not just the liabilities. And that's the right thing to do, and it has enabled us to make decisions like we did today, to come to final investment decision on Sizewell C, which will, when it's built in a decade's time, provide the equivalent of electricity for 6 million homes for 60 years. That is a big achievement, but would not have been possible without those changes in the fiscal rules. I know that's a lot of detail, but that is my growth strategy.
Thank you for that full answer and strategy. Just a quick follow-up then. Obviously the UK economy is having issues. The growth is still rather sluggish. Unemployment is increasing. Inflation, as we found out this morning, is still a stubborn problem. What's your diagnosis of the ills of the UK economy? What are the problems that continue to plague the UK economy at the moment?
The key problem is productivity, and sort of investment is the answer. Investment in human capital, investment in physical capital, and also investment in new technologies. That's both public and private sector, but I think we've got the lowest private investment and lowest total investment as a share of GDP of any country in the G7. The result of that is that our productivity performance has not kept pace with our competitors and similar countries around the world. And that's why the fiscal rules that I've set out do treat investment spending different. Because what you saw, and you saw this in the previous Parliament, and the plans that we inherited saw public investment as a share of GDP fall to 1.7% to GDP. And we're instead going to keep it at 2.5%, 2.5% of GDP. The easy thing to do as a Chancellor is to cut capital spending because, frankly, you're not likely to be the government that sees the benefit, the full benefit of that capital spending. But we're not going to keep making those short-sighted, wrong decisions, which is why we've set out those changes to the fiscal rules. But productivity, I regard as the key reason why our performance on government borrowing and debt, why our performance on GDP and our performance on inflation have all been not where we would want them to be. And my job as Chancellor is to turn that around.
Thank you. A brief follow-up from Lord Blackwell.
Thank you. Chancellor, I just wondered, you mentioned the high levels of taxation at the moment, which, as you say, have been rising in recent years. Since the war, no government has, until now, managed to get more than 35% of GDP in taxation. It's now about 37.5%. Do you have a view on what is sustainable in terms of levels of taxation? I mean, the OBR, as you know, forecast that with the ageing population, government expenditure could go up to 60% of GDP within the lifetime of current young people. Do you have a ceiling or view on what is the right level of taxation in the long run once you get through the current debt problem?
So the OBR forecast for this Parliament have in the final year of the forecast period tax as a share of GDP at 38%. That's not a target, but that reflects the fiscal rules that, those are the things that are my constraints and the anchor for fiscal policy are those two fiscal rules rather than a tax to GDP ratio. What I would argue is the best way to reduce that ratio but still have public services that we need is to increase the denominator, to increase GDP. And that is where all my focus is, because if we can grow the economy, then you can reduce that ratio without cutting investment in public services. But I also say that public services is not just about money. We've got to reform the way our public services work. And that's why we did a zero-based review as part of the spending review. First time the government's done a zero-based review since 2007. And in that zero-based review, we managed to find bits of government spending that we just didn't need to do anymore. In the Treasury, we are cutting the cost of government by 20%, and that admin reduction is the same for all areas of government. Of course, in the Treasury, it bites a bit more because almost everything we do is admin costs. So I think the way, if you want to reduce that tax burden, is to increase GDP, and that's what I'm focused on.
So your target would be to decrease that ratio rather than allow it to increase?
Well, I've got to set out my fiscal rules, and those fiscal rules are not a tax as a share of GDP rule. It's a stability rule to balance day-to-day spending with tax receipts, and investment rule to get debt down as a share of GDP. The 38% is where we end up at the end of this period, but my focus is on growing the economy, which is what I think the investment rule really enables, and the stability rule means that the Bank of England can continue to cut interest rates as they've done 4 times in this last year.
Lord Pettigrew, over to you.
Chancellor, my question is about the rolling debt target framework, and you may recall that in its national debt inquiry, this committee was very critical of the concept because it can be gamed, and I quote, allows the possibility of debt rising for 4 years with success being claimed if it falls in year 5, even if debt at the end of the 5-year period is higher than in the first year. I should say that is also compounded by there's a sense that there's a systemic bias, optimism bias on our growth forecasts. And so the question is, given that you have retained the existing rolling target system, does this mean that we should heavily, or the market should heavily discount claims to meet the stability rule based on future tightening?
Thank you very much, Lord Pettigrew. We have changed that the 5-year to 3-year. And so in the first year, it was 5 years, then it becomes 4 years, then it becomes 3 years, and then it rolls 3 years after that. So for the first 2 years, actually there's no rolling. We just move towards it. And the 3-year is trying to get us out of this situation where it's always in the next Parliament Lord may be virtuous, but not quite yet. So the whole point of bringing it forward 2 years is so that the horizon isn't too far in the future, and also because of debt dynamics, you can't you can't game the system, because if you are taking on more debt, then you have those debt servicing costs that push up the debt to GDP ratio in future years. So I think the 3-year target is the right one. You'd never want to have it for that year, but I think the 3 years is right. But if you look at the OBR forecasts, it has us currently meeting both rules, the stability rule and the investment rule, 2 years early at a 3-year horizon, not a 5-year horizon, and it has both debt to GDP and the deficit as a share of GDP falling over that 5-year horizon. So it's not flat and then falling in the 5th year, which is, I think, the criticism of how the system has been gamed in the past. I don't want to meet the fiscal rules in that way. I want to genuinely meet those fiscal rules rules with policy that is sustainable, which again, to come back to this point, it's why we've taken investment out of the stability rule, because I don't want to be in a position where, you cut a major transport infrastructure project or an energy infrastructure project, or you decide you're not going to build 300,000 homes a year, you're going to build 50,000 this year because you can't afford it according to your fiscal rules. So I think we've got the right balance there, but recognising that a 5-year rolling target means, I know you never get to 3 years either, but 3 years is a bit nearer, and the debt dynamics means it's harder to game the system.
I think that the point I just add, if I could, is that the 3-year period is also the duration of the spending review period. So that 3-year horizon is covered by spending plans that are detailed and at departmental level. So I think that guards against some of the sort of Augustinian approaches that you've seen in the past for those sort of rolling targets.
I may just one more question. And so is it fair to go back to the comment on, and your comment on GDP being effectively the GDP growth, or productivity growth being the core variable and the whole multivariable model? We had the OBR come here. We also had the Bank of England come. It seemed to me that there was a debate, the OBR being a little bit more optimistic than the Bank of England. And so the question, I think the big risk in this 3-year, even if it's reduced, is whether these GDP forecasts are hit or not. And therefore that, I think, must be the key variable.
Well, I mean, that is a statement of fact, Lord Pendergast, and as you rightly say, the OBR forecasts for productivity and growth are substantially higher than other forecasters. We are at the moment on track to meet the OBR forecasts for growth for this year. But, growth is not exogenous. We can have an impact on growth, and that's why we're pursuing these policies around reform and investment to try and make Britain the most attractive place to start, to scale, to grow a business, and also for inward investment to come. And, today, when we announced final investment decision for Sizewell C, not just government money going into that, but EDF investment, Centrica, Amber, and the Canadian Pension Fund, CDPQ. I think that shows that Britain is increasingly an attractive place to invest. And I think in the first year of the government, we secured £120 billion of inward investment, and today's announcement, of course, is on top of that.
Thank you very much. Lord Lonsborough.
Good afternoon, Chancellor. Can we zero in on what you describe as the key problem of the economy, which is the critical issue of low levels of productivity in the UK? And we continue to lag France, Germany, the US by very wide margins, about 12 to 20% in terms of output per hour. And we have done so for decades. Now, the UK's productivity in this first quarter has actually fallen by 0.2% compared to a year ago, and it's standing now at just 1% higher than it was 5 years ago. And it may well drop in Q2, given what's happening to GDP numbers. So my question is, how is the government seeking to address this productivity challenge? What specific policies will turn the dial, and when can we expect to see results?
Yeah, so there are sort of three things that affect, I guess, the productivity numbers. It's physical capital, labour supply, and that's the quality of the labour supply, so human capital as well as the numbers, and then total factor productivity, so technology. On capital, I'd say, sort of an assessment of the first year. I think on physical capital, that's where we've done most. In this first year, I've mentioned the £120 billion of extra CDEL capital spending by the government over the 5-year period, keeping capital spending by government flat as a share of GDP rather than it falling actually quite substantially, which was the plans that we inherited, but also using financial transactions through the National Wealth Fund and the British Business Bank and other public financial institutions to have additional capital spending, and then using things like the National Wealth Fund to leverage leverage in private investment, 3 times as much private investment, and actually that's the model we've used as well for Sizewell C, where the National Wealth Fund is the sort of debt underwriter for that project. And as I said to Lord Pettigas, we've managed to bring in £120 billion of private investment just in this first year of the Labour government. On labour supply, you would have seen, despite the increases in the unemployment rate, we've also seen an increase in the employment rate. And those two things can obviously be consistent, because what we've seen is a reduction in economic inactivity. And that's really positive, because we are still the only OECD country, I think, that's got a lower participation rate in the labour market than before the pandemic. And so reducing those economic inactivity numbers are absolutely crucial. The first step is that you move from being inactive to looking for work, and then hopefully you move into work. And there are still around 650,000, 700,000 vacancies in the economy. And, we want to better match the people that are available for work with the jobs that are available. And we want to help those people who are currently economically inactive, whether that's because they took early retirement and maybe now perhaps regretting that, and that is the experience of some people during the sort of COVID period, whether you are a parent who is struggling to balance work and childcare, or whether you're one of the growing number of people on sickness and disability benefits, where we know that there are many people who are desperate to work but are not given the support. We also, in the spending review, invested significantly in both apprenticeships and further education, because that has been the sort of Cinderella service of the education system this last decade and a half. It's great that we've got 50% of kids going to university, but the 50% who don't, which in my constituency in Leeds Western Pudsey, there'll be the majority of kids don't go to university. So investing in FE and apprenticeships is really crucial for this government and our wider objectives around opportunity. So we've done some of that spending review, but I certainly think that's an area where we can do more to address the productivity issue through improving labour supply and human capital. And then the last thing is around sort of technology, total factor productivity. And Andy Haldane, former chief economist at Bank of England, talks about this long tail of low productivity firms. And the DSIT secretary, Peter Kyle, he's sort of got 3 focuses in his area. First of all, it's attractive businesses that are at the technological frontier. Obviously, that is crucial for growth, and we're very good at that in Britain. We've got a lot of very high-skilled people. I was at Imperial College this morning. That's an area where we are good, but we shouldn't rest on our laurels. The second area is using technology better in delivering public services. That's this issue about not just how much we spend on public services, but about getting value for money. And then the third is the sort of point around that long tail of productivity, about better take-up of AI and technology by smaller businesses and less productive firms. And so we're working in all of those areas, and there is a big opportunity. The IMF and others say that if we integrate AI and technology, we could boost productivity by 1.5%. Over the next 10 years. So there's huge opportunities there, and we've got to seize them, but we are very focused, as I hope you can tell, on that agenda. And
can I ask you about the fiscal impact of continuing low productivity, in that the OBR admits that its productivity forecasts are, to quote them, the most important yet uncertain forecast judgments they make. And they admit to the fact they've been successively too optimistic on productivity forecasts. And if current productivity trend forecasts that are assumed by the OBR of 1% growing to 1.2% over the forecast period to 2029 currently looks very optimistic, and certainly that's the Bank of England's view, what will be the fiscal consequences if productivity continues at the current low rates, which averaging about 0.2% per annum over the last 5 years?
Yeah, so the OBR forecast long-term productivity growth of 1.25% a year, and the Bank of England have a forecast of 1% a year. Both are very low by historic standards. Productivity over a long period of time is higher than that, but as you rightly say, the last decade and a half has been lower. So I guess you've got to decide whether you think that you should just look at a short period of time for what average productivity is, or long-term productivity, or whether you should look at a longer time series. And the OBR, as they've said, are looking at that at the moment. But perhaps I'll pass on to Steve to give a bit more detail.
Yeah, I mean, I saw the evidence that David Miles gave, and I think he gave a sort of balanced assessment of where the OBR had come out, which is that they think that productivity has been depressed by a series of shocks over the last 15 years. But even abstracting from that, they're certainly not expecting productivity to return to the pre-financial crisis levels of 2.5%. But equally, you can veer into the too pessimistic, into the views that the recent numbers we've seen at 0.2 are likely to persist. And their view was that there were reasons both to expect that the sequence of shocks might not continue, but also that there is potential for future technologies, in particular AI as a potential new general purpose technology, to be a source of the innovation that you need in TFP growth that supports their forecast of productivity gradually picking back up to 1.25%. I think one of the elements I would add is to the list that the Chancellor gave of policy measures is the impact of the government's planning reforms to support productivity, which the OBR scored as increasing GDP within the 5-year forecast, which is also a very good example, I think, of coming to your first question, Lord Wood, of how is it possible to sort of increase productivity given the constraints of the fiscal position. I think those steps on planning are a really good example of how it is actually possible to do that.
My concern is probably more about the short term, in that the current forecast in the OBR looks very optimistic and I'd say ripe for downgrade, and that's echoed by the consensus of independent forecasters. And I think the Bank of England has actually downgraded its productivity forecast to 0.6 or 0.7%. So that's going to have an immediate fiscal impact this autumn, is it not?
The Bank of England's forecast of productivity, long-term productivity growth, is 1%.
Long term, yes.
Yeah, and that's what sort of drives the models, really. But the OBR is higher than that. The number I gave you earlier was just slightly wrong. So the IMF analysis suggests AI could boost UK cumulative total factor productivity over the next 5 years by 1.4%. And so I guess that's the point that sort of Steve Farrington is making, that there have been a series of shocks over the last few years, whether it's the sort of global financial crisis, COVID, Russia's illegal invasion of Ukraine, that have all had a negative effect on productivity and growth. But actually, if you look at some of the underlying drivers of productivity, there is perhaps reason to be more optimistic in the future if we can contain some of those shocks, in part by building a more resilient economy, and that's what we're trying to do with clean energy, homegrown energy, for example. But some of those underlying factors about the increasing use of technology might give us a bit more cause for optimism.
Thank you.
Lord Turnbull.
I don't know whether on your desk you have Kraft Hamlet's complaint, when sorrows come, they come not as single spies but in battalions. So let me pick up one of those battalions, which is demographics. Much has been written about the impact on public finances of the growth in the number of older people. Less appreciated, I think, is the alarming or certainly severe worsening of the dependency ratio. We used to think of the labour market starting at 16. Not many young people go to work at 16 these days. Sometimes it takes them until their mid-20s. The birth rate is very low. And so the circle has been squared by the acceptance of the promotion, the acceptance of very high levels of net migration. And there are also concerns whether the people who are now coming have the same characteristics as those who used to 15 years ago, whether they want to stay more, bring more dependence. So how do you square this migration issue with protecting the public finances, the needs of the labour market, big shortages in health care and food processing, and the social pressures that the migration is causing?
Thank you very much for your question, Lord Turnbull. Countries around the world, certainly developed countries around the world, face a number of demographic challenges. The UK is not the worst by a long way, but we do face some of those demographic challenges as well. As you would have seen on Monday this week, we launched a pensions commission to look at the adequacy of pensions in retirement and also the state pension age. I think one of the most transformational pieces of public policy in the last couple of decades is automatic enrolment into pensions. That's brought 11 million people into saving for retirement who weren't previously doing so. But the truth is, a lot of people, even with automatic enrolment, find that their pension pot is not worth as much as they need it to be worth on retirement. And so that's why the Pensions Minister, Torsten Bell, has just started that piece of work, led by, is it Susie Morrissey, is doing the Pensions Commission? I think it's Susie Morrissey doing the work on the Pensions Commission, and then Baroness Drake and Sir Ian Cheshire, and Nick Pearce, Professor Nick Pearce, are doing that wider piece of work on the adequacy of pensions. So that's the important work that is ongoing. You'd also see in the pensions bill is making its way through Parliament at the moment to create those mega funds in pensions, so that when people do save for retirement, they get a better return on those savings, more similar to what you've got in Canada or Australia or the Netherlands, for example, where you've got a smaller number of big pension schemes that generate better returns for savers. And what I set out at my Mansion House speech last year, and then the pensions bill is aimed at a consolidation in pensions, and the Mansion House Accord, which we agreed with around 90% of the biggest pension funds have agreed to invest 10% of their main funds in private assets, of which half should be in UK assets. So there are opportunities here, as well as concerns around sort of fiscal sustainability. In terms of immigration to meet the sort of skills need and the labour demand in the economy, my first answer will be, well, there are a lot of people here in Britain who are not working, either because they are unemployed or because they are economically inactive. We've got 20% of people of working age who are economically inactive, and we've got an unemployment rate of just over 4%. And so I do not think that businesses should always resort to the immigration lever to fill vacancies. We need to do much more to train up people who are already in this country. There are those 650, 700,000 vacancies in the economy. There are plenty of people of working age in this economy. With the right support, they should be able to work. And that's why in the budget last year, I set out a series of trailblazers working with the directly elected mayors to help people in their mayoral combined authorities to get back to work, with a focus particularly on young people. We've got 1 in 8 young people not in education, employment or training. That is not acceptable, and we need to do much more to make sure that those opportunities are there for those young people. And it's why as well we've announced £1 billion of support to help people who are currently not in the labour market back into work. So, immigration has always played and will continue to play an important part of the skills mix, but we can't just turn to the immigration lever. We do need to do much more to train people up who are already in this country.
One quick supplementary. You said in the past it was the easy thing was to cut capital. You changed the rules to favour capital more. But the first thing you announced, I think more or less, was the cancellation of 2 major roads projects, Arundel Bypass and Stonehenge. Would you have done that now under the rules that you are now operating now?
Yes,
because the revenue gain was they couldn't be afforded. Didn't say anything about whether they were good projects or not, it just said they couldn't be afforded.
We've set out £750 billion of spending during the course of this Parliament, but of course, through the course of the spending review, there were plenty of projects that we had to say no to, because even with £120 billion more public investment than the plans we inherited, you still can't do everything that everybody would like to do. There's always going to be more demands on public resources than we have money available, and we have to prioritise because there is not a limitless pot of money as much as people might like there to be, or sometimes think there is. So even with the additional money available, we still have to make priorities. I'd also say this, we did have to cancel things, but we cancelled things where the money was not there. There are lots and lots of projects that the previous government had announced, had committed to delivering, without allocating a single penny to pay for them. And that is how you end up in politics, with the levels of distrust of politicians and of the democratic system. And I do think it is unforgivable to make a load of commitments without having a single clue about where the money was going to come from. I'm not going to do that. And it doesn't mean you're going to have to disappoint people sometimes, but I always think it's better to be honest than to say that you can achieve something without saying where the money's going to come from. And that's why we've just done a multi-year spending review where we've settled departmental budgets for day-to-day spending for 3 years and for capital spending for 5 years. And alongside that, we've published a 10-year national infrastructure plan. Difference between this and what we inherited is every single thing that we've said we're going to do in the next 3 years for day-to-day spending and the next 5 years for capital spending is fully funded, fully costed, and that is very, very different to the plans that we inherited. So yes, we had to cancel things, but we had to cancel things that would never have been delivered because there wasn't a single penny allocated to them.
Lord Blackwell.
Thank you. Chancellor, one of the other long-term challenges you're having to deal with as Chancellor is the rising cost of welfare. This committee recently completed a report on the economic impact of long-term sickness, and as you'll be very well aware, spending on incapacity and disability benefits has risen more than 40% over the last decade. There are currently 3.7 million people who receive the health component of universal credit, 95% of whom aren't working, and 80% of whom have been out of work for more than 2 years, tragically many of them young. But what we've discovered from the evidence is that this doesn't seem to reflect any rise in sickness levels in the population as a whole. In fact, the survey of health of the nation has been pretty stable over that period. So the conclusion that we and many others have come to is that it has more to do with the structure of the benefits system and the incentives within it. Indeed, Alison McGovern, the Employment Minister, told us the current system doesn't work. It was supposed to be designed to incentivize work, and it's turned out not to do that. And it's obvious that it's not financially sustainable. So my question is, do you agree with that assessment? And I know you're waiting for the Timms report, but do you accept that if we're going to deal with the ballooning cost of credit and indeed help the people who are in this situation, that'll need much more fundamental reforms for both economic and social reasons?
Well, thank you very much for that very topical question. As you say, Stephen Timms is doing the review now of sickness and disability benefits of personal independence payments, but we're not just going to wait for that review. Before COVID, 7 in 10 assessments for personal independence payments were done face-to-face. It's now 1 in 10. I don't think anyone truly believes that those assessments are going to be as effective on the phone or on Zoom or whatever as they would be if they were face-to-face by better trained and better supported assessors. And so we are changing that by recruiting and giving DWP the resource to have more trained assessors and more face-to-face assessments to ensure that people who need the support get it. but then people who are able to work are given the support to get back into work. At the same time, we're providing £1 billion worth of support to help people who are economically inactive back to work, and that will also include supporting NEETs, where I think that the biggest crisis exists, because we know that if you're out of work early in your working life, you are going to earn less and be in work less over the whole period of 50 years that you should be in the labour market. So a real focus on back to work support and face-to-face assessments, as well as the TIMS review. On universal credit, we are making reforms. We are in real terms reducing the health element of universal credit and increasing the standard allowance, because we know that a lot of people have found it almost impossible to live on the standard allowance, and all of the big charities, Joseph Rowntree, etc., say the standard allowance was not enough to live on, and so people were doing their very best to get onto the health element. And once you're on the health element, you don't have to be actively seeking employment. So narrowing the gap between those two benefits, I think, is one important way in which we can encourage more people to be actually looking for work. I'll also just give you a couple of statistics which I think are quite telling about people on sickness and disability benefits. There are 200,000 people who are claiming health and disability benefits who said that they would work if the right job and support were available. It's 200,000 people. An additional 1 million people say that they would be able to work in the future if their health improved. And so the investment we're putting into the National Health Service on both physical and mental health, as well as that targeted back-to-work support, is about enabling people and giving people the support that they need to access work that is appropriate for them. We're already seeing a reduction in the economic inactivity rate. That is really encouraging, but there's an awful lot more that we need to do to help more people of working age have the fulfilment that I believe comes from having a job.
I'm sure you'll be the first to say this isn't just an economic issue, but would you measure your success by the fact that in 5 years' time there ought to be a lot fewer people on health-related benefits and a lot more of them in employment?
Well, let's just be clear, even with the original plans in the legislation, you would have seen an increase in the number of people on personal independence payments. All our plans would have done was to stem some of that increase. I want more people to be in work. I believe it is good for them, good for their families, and good for the economy. You're half as likely to be in poverty if you are in work compared to if you are on benefits. We also need to support people in work with greater security in work, which we're doing through the Employment Rights Bill, and also by a wage that you can afford to live on, which is why we increased both the national minimum wage and the national living wage in the budget last year. So I do want to see more people have that chance of meaningful employment, which is why we're investing in skills and training, and it's also why we're putting that support in to help people back into work. And the TIMS review, of course, is looking at that gateway to sickness and disability benefits.
A related question from Lord Vergy.
Thank you, Chancellor. What are the fiscal consequences of the government's concessions to ensure the passing of the benefits bill? Does the short-term volatility in government policy undermine the UK's fiscal credibility? And how are you going to address some very painful long-term decisions we have to make with the short-term volatility in government policy at the moment?
So, as the Secretary of State for Work and Pensions said at the time, of course there is a cost for the changes on the